Well, hello guys, and welcome to this live stream event. This is the pre-show part, just starting a little bit before 8 p.m. And hopefully everybody is there. I've got quite a few people on the live chat so far, so we'll just recognise a few of the people who've called in. Fatman2434 from New Zealand was the first on. Hi to you. Eric, Dale, Keen Fei, Woo, Mark Foster, Adam, Oliver, Eva Gardens, Lisa, Jace, Darryl, a few others there too. James, Wiser3754, I'm lost. A few others too. Very good. And nice to see Matt, for example, from Brisbane, but also we've got people from Christchurch. So Oliver's from Christchurch in New Zealand. I think I saw Glennis there too. Brad, Pat. A few others too. Good. Hello, Bruce. Good to see you there. And hopefully it's all working. I'm always holding my breath at this stage just to make sure that everything is as streaming as it should, but I think it probably is. Just watching the rest of the stream. Alex, hello Alex. G'day Bondi Steve. Hi Linda from Sunbury. Sean. Joy Tech Community, good day. Peter, hello to everybody. Yep, indeed. The gang is all here. Yeah, it's good to see. And thank you very much for making the time to spend with me. This is the last one of these for this year, but plenty to talk about once again. Sounds good. Thank you, Brad. That's good to hear. I'm always a little bit twitchy when I set this thing up. We do try to... Michelson, we haven't formally started the show. The good news is that in a moment or two, we'll be able to play the drum roll. We can't miss out on the drum roll, but I haven't said today, so at least not yet. So that's just one of those little foibles. Marty, hello. Anthony, Eric, waiting for a train. Adam, give us the help today. John Adams says the ghost of John Adams is here. So is John Adams real is the question, I guess. Hello, John. Yes, good to see a few more on as well. It's great. Just going to run this for a moment or two longer. And if you are watching the recorded version, I do actually edit the part beforehand and put up the time when the formal show starts. Glenn says, hello, John Adams and Joe Wilkes. Joe must be there. I haven't seen him. Pressure Girl, hello. Vanessa, Brendan, Phoenix. Good. Good to see some of the names that we see on the chat. DUE, hello. Moet. Took off early to be here. Well done. I'm very impressed at your persistence to be here on time and in budget. Well done. I'm just watching the last few names there. I'm going to run this for one or two more moments and then we'll go into the formal part of the show. Just so everyone's clear, this runs roughly for about an hour and 15 plus or minus, but it depends a bit on the questions that we get and the discussion that we get into. Joseph mentions his trip to Auckland. I have spent a happy 2 days downloading loads and loads of videos that Joe took. Some of them are quite shocking, actually, so we're going to make a series of programs on that. I have to say, from what I've seen on Joe's videos, there is plenty of spare property in and around Auckland. Fly Individual, hello. Justin. Jeff tuning in. The New Voice 8. Luke. Matt. John L. That's good. All right, so I'm just going to run this for another 30 seconds and then we'll get into formal show mode. Joseph is on. Hello, Joseph. Good to see you there. finally got the last of those pesky files downloaded. Glenn says, interested in Auckland. Yeah, I was really surprised. There is a lot of material. And by the way, Joe got a better microphone so we can actually hear what he says, which was a big improvement. Okay, so what I'm going to do now is I'm going to run the intro, so you now get the drum beat, and then I'll come back and formally start the real show. All being well, this is when I push the button and nothing happens, but fingers crossed. Well, good evening and welcome to the live stream event. This is Martin North from Digital Finance Analytics. And of course, I should say today, welcome to this live stream on the 18th of December 2018. Great to have you on board and excellent to see so many on. Those watching the pre-stream, the pre-launch will have, of course, already sort of made contact. There are a bunch of other people coming on now. What I'm going to do though is I'm just for a little while going to ignore the live chat, because what I want to do is just give you a little bit of an introduction. Some of it is pretty standard, but I also have got a few extra charts, and then we'll get into the Q&A. So if you've got specific questions that you want to ask me, hold on to them for the moment, and use the @WalkTheWorld if you want to get my attention. That would be quite helpful. But what I'm now going to do is to switch across to the PC screen. Okay, hopefully that is all working. So this is essentially just a few slides to really cover some of the things that we're going to cover in more detail tonight. Start with the running order. So this introduction, well, you've had the introduction now. I want to talk about the house rules, just a few little things. I'll then talk about the models that we use because they're so fundamental to the way that we do things. I'll then just touch on a few key slides, which are sort of some updating, breaking news, as it were, and then we'll go into the Q&A. So the bulk of it will be Q&A, and there'll be plenty of time for questions as we go along. And then we'll sign off, and it'll be about an hour and 20 minutes probably by the time we've run through. So just the house rules, this is quite important. Please note this is not financial advice. I'm not qualified to give financial advice. I don't know your individual circumstances, and it will be illegal for me to give financial advice. So this is just my opinion based on my research, based on what I think is going on. But to the extent that it's useful or valuable, take it or leave it. But please understand it is not financial advice. Please play nice in the chat room. It is actively moderated. I will be watching chat as it comes through. I have already taken one or two out and allowed a few others to come through. So please play nice. There's plenty of excellent conversation to be had, and we don't need to have any abuse in the chat room, so please respect those rules. Just to stress again, this is the 18th of December 2018. So if you're watching this in 10 years' time and the property market's gone up 200%, blame me. No, don't blame me, but this is as at today's date. Use @WalkTheWorld to get my attention if you want to ask a question. I do have a lot of chat going on in the chat room, and I won't necessarily be able to pick up every conversation and every comment. Feel free to have other conversations and other comments, but if you want me to address something specifically, use @WalkTheWorld, please. Now, in terms of the model, this is just a very quick overview for those who may not have seen it before. So there is a science behind what we do here. We survey consumers, we survey SMEs, we survey brokers. We also have data coming in from our clients, and that all goes into our core industry model. The 52,000 households is where we do our analysis, and that then supports the industry reports, the channel reports, the other stuff that we do. It also includes information from industry sources and also trading results as well. So that's the way the model works. Been running this model now for about 12 years, and it's got some AI in the middle of it to make some of the projections that we make. We'll touch on those a little later. And it's like a Rubik's Cube, so we can slice it and dice it by property status, by geography, by state, or even by our master segmentation. Now, of course, this is Australian-based. We have now started to engage with New Zealand, particularly with Joe's help, and so there's now an interesting question going through my mind as to whether we can do something similar over in New Zealand too, but not sure about that yet. It's on the list of things to think about. Now, let me just touch on a few things. So the reserve minutes came out today. One of the reasons why we do it tonight is because we have the reserve minutes, and of course, guess what? They highlighted, well, firstly, they highlighted slowing global growth. This is a really changed theme from a few months ago, and all the latest information is now talking about slowing global growth rather than actually synchronized growth, which we had a few months ago. It's a big change, I think. Secondly, they revised their GDP growth expectations around 3%. MyEFO had 2.75% for next year, so there is still some downside movement in terms of the GDP growth expectations. And in fact, I think the Reserve Bank is way too positive in terms of growth. They talk about a decline in demand for off-the-plan apartments. We've seen that in spades through our various research programs and surveys. That's very important. Now they recognise it. And they're also making the point that over the last 5 years, earnings have matched consumer prices. So no real change in income, despite any productivity growth or anything. So in many cases, in fact, my research says people have actually gone backward. This income problem is probably one of the most significant factors in the economy at the moment. Then they talked about a pickup in business lending, mainly to large corporates, as the banks have effectively switched away perhaps from their home lending, although, of course, home lending is still growing. But they also make the point that the SMEs are actually struggling with funding. A lot of SMEs are really up against it now because a lot of them are now having to use their homes for security, and so going through all the same issues there. And then the outlook for household consumption continues to be a source of uncertainty, they say, because of the growth in household income, debt levels, and declines in house prices. Well, all that stuff you know if you've been watching the DFA channel, but at least the Reserve Bank is recognising it. And then, of course, they say, well, the next move will probably be up. Now, you could argue that this was then, things may have changed now, but at the moment the Reserve Bank is still signalling a move up. So that's in a nutshell what the Reserve Bank said. Now, just a few other quick things. Credit still growing at 5.1%. This is the analysed data from the RBA. So housing credit is still growing at 5.1%. That's faster than inflation. So all the talk about no credit availability is not the true story, particularly for owner-occupied occupation. Investors are growing at 1.3%. Owner-occupied are 7%. Average 5.1%. And that's actually faster than business lending. Household confidence from our surveys is in the doldrums. This is a chart that actually John Adams liked, which showed the way that household financial confidence is sliding below the 100, which is the baseline. But actually those who are mortgaged are less confident than those who aren't. So we call them the free affluent. So they're the ones with perhaps more affluence, less mortgages or no mortgages, still got property. And both of those, though, are still more positive compared with those who are renting. So renters definitely are bouncing along the bottom in terms of household confidence. But this is critical because it does tell you that things are actually quite tight for many people. Mortgage stress is also rising. This is the other data, of course, that we report every month. 30.9%. That's more than 1 million households now in mortgage stress, defined as on cash flow terms. And, of course, the household debt-to-income ratio, 190.5. It's never been higher, one of the highest in the world. And that's where a lot of our grief comes from. We've got too much debt, or we're over-leveraged. BBSW is another one. This is the funding. So this is the funding gap between effectively what the banks are trying to deal with. It's gone up 23.5 basis points now from where it was back in February. It's rising again, and my expectation is that it will rise further. They haven't clawed back all of that in Australia. So the banks are sitting on margin compression, and what they're actually doing is raiding people's savings, squeezing deposits, particularly term deposits, to try and square the circle. But the BBSW rates are very significant, and we monitor those on an ongoing basis. And the market, of course, had a pretty riotous day today. It went down more than 1%. But the financial sector, which is what this chart is, this is effectively the index for the financials in Australia, dropped another 1.5%. And if you look at it in long-term trend terms, it's now basically back to where it was back in 2012, 2013. So effectively all of the movement in between has been lost, and my own view is there's probably more slides ahead. Now, just in terms of our scenarios, we always update our scenarios on this call, and I've run the model again, coming out of the back of our core market model. Scenarios is a way of looking at the industry, as you know. We use them to help discuss. We're not necessarily making a forecast, but it's illustrating how things are changing over time. And we've got these same scenarios with business as usual, things going to get better, not yet doomsday, Armageddon, Ireland 2.0, and doomsday, Iceland 2.0. And then I've updated the scenario. So the business as usual, this is effectively the Reserve Bank sort of baseline, has dropped to 2% probability. So there's almost no chance of what the Reserve Bank is expecting to play out. And in fact, even the thing's going to get better has dropped from 30% to 25% in my scenario analysis here. And here we're talking about home prices down 20%, up to 20%. And perhaps some easing of credit rules to try and stimulate. If you go on beyond that to what I call not yet doomsday, so this is now when we're talking 20 to 30% price moves. This is price moves from peak to trough. We've now got a 45% probability weighting on this scenario playing out, up from 42.5% last time we ran the models. And at this point, you've got losses rising, you've got mortgage stress rising, you've got the Reserve Bank rate sort of sitting around 1.5%, in other words, no move up. Then we go on to Armageddon, and this is when it gets really, really serious. So now we've got 0 or 0.5%, that sort of range for the Reserve Bank rate. We've got huge amounts of mortgage stress, unemployment rising, significant bank losses, home prices down 30 to 45%, and probably some bail-ins and bailouts going on. And that's now got a 20% probability, up from 17.5%. And then the last one, which is effectively, the whole thing sort of falls over, 0 and below interest rates, high unemployment rate, high levels of mortgage stress, huge bank losses, prices up to 80%. That's got a 5% weighting now. It's gone up from 4 to 5%. And that tells you that the midpoint is somewhere between 20 and 30% in terms of home price down from peak to trough. Various places you look at, Sydney, Melbourne, more than perhaps some other places. But that's quite significant. And it is definitely higher than what many of the economists out there are saying. And I think that you can perhaps get a sense of, yeah, that's probably where I'm thinking, but what I'm saying is the downside beyond that is probably even more significant. So that's our latest update based on the data, literally up till today. Okay, so with that introduction, I'm now going to come back to the chat, and to do that, I'm going to come back on to this one. Oops. Let's go back there. Okay. So, on the Q&A, let's have a look. Going to have a look back over and just see what we've got. We need a reset, somebody said. Yeah, probably do. Based on your knowledge and opinion, where would you park your money to protect it, assuming the Aussie dollar is at significant risk? That's from JoyTech22. Good question. Depends whether you're trying to... Is it just for protection, or is it essentially trying to gain from the situation? It's actually quite difficult to figure out where there might be safe, because safe is relative, right? So in some cases, people are saying, well, maybe the bank deposits, and you've got to think about bail-in and bail-out. You might think about moving money overseas, but then you've got exchange rate risk. You might think of, metals, but then you've got issues with storage and also with price on metals. So the short answer is there is no simple solution, and there's no safe place. It's all about relative risk, and you'll make then a trade-off risk between different scenarios and basically different solutions. But there is no 100% copper-bottomed place, not even under the mattress, because of course there if you have a fire, then you lose it all. So I'm afraid there's no simple answers to that question. Oliver says, I was earning more 20 years ago. Yeah, there's a lot of people who actually have had no pay rises for 5, 7, 8, 10, 12 years. And in some cases now, their employment that they've got is actually paying less than it was back then. We are in a very different situation, and that's partly created by the gig economy, partly created by the pressure on wages and the fact that perhaps many parts of the economy now are less unionized than they were. It's also worth comparing the returns from the commercial sector, in other words, to investors, relative to the returns to those who are actually working. And effectively, relatively, the pendulum has swung very heavily towards those who are actually investors compared with those who are actually working. And I think we've got to find a way to get the pendulum back, because at the moment, many people are in multiple jobs, chasing effectively enough money to try and actually keep the wolf from the door, as it were. So it's a big deal. Okay, let's see what else is coming up. So Megan was asking, how many think the global economy will crash? Well, you're raising a very interesting question there, because a lot of what I've been talking about so far is based on the local situation, right? But the really interesting question is the impact internationally. So there's a bunch of issues internationally which potentially will impinge on us. So I'm thinking of the Fed in the US, I'm thinking of China, I'm thinking of Brexit, and I'm thinking of a bunch of other things too, all of which potentially have risks attached to them. And it's a question of to what extent are we disconnected from it, and the answer is we're not. So our banks are funded from overseas. We have more than $1 trillion of overseas debt. We have a lot of international investors investing in Australia, and traditionally we've been quite a strong attractor of investment, and all of that is at risk potentially if things go a bit pear-shaped. And then, of course, you've got more issues with regard to the trade wars, and you've got greater degrees of defensiveness and less sort of interest in globalization and more about localization. So there's a big deal, and I think that there is a significant risk to the overall economy globally, as well as our own economy. We can make it up quite well here in terms of actually we can create our own problems quite well without any international impacts. But my latest scenario does assume some global impact. Okay, let's have a look. What else is going? So the only way to survive and get ahead is to work 60 hours a week. It's killing the average family. That's from Goldlad. Yeah, a lot of people are working very hard. So my surveys highlight the fact that many households are really up against it. So that, effectively there is pressure on household budgets thanks to fuel, electricity, childcare costs, healthcare costs, all of those things. Income's flat in real terms, big mortgages, in some cases mortgage rates have even gone up for some people, and then no real growth in income. It's looking very, very uncomfortable for many households, and that's why I talk about mortgage stress as being a significant factor for many. I also measure rental stress. About 40% of people who are renting actually have rental stress. In other words, they're struggling to make the rental repayments on the properties that they're actually living in. That's one reason why rents are not growing in real terms at all. So it's a big deal. Okay, what else have we got? Okay. Yes, so there's the normal discussion about gold, and there is a line of argument that gold is tangible, so you can actually go buy gold and you can hold it. The problem is, of course, one, what is the price of gold and what might the price of gold become? Bearing in mind that to some extent I think the gold price is artificially manipulated even now. And two, of course, we've always got that old law that the government can go grab gold here if they so choose at whatever price they chose. So gold's an issue, interesting question. It's not without its risks though. Matt says, I got your message about whether money in offset accounts can be bailed in. Yeah, okay, let's talk about that, Matt. So Matt asked me, in a bail-in situation, and let's just wind back slightly. So bail-in is when a bank is failing but has not failed, And the bail-in arrangements allows types of assets like bonds or even deposits potentially to be converted to equity to bolster the bank's balance sheet and keep it in business. So that's what bail-in's about. And the question is, if I've got a loan, mortgage, and I've got an offset account, in a bail-in situation, how might that play out? Now, traditionally, the standard argument that a banker would say is, well, I have ultimate right of offset immediately, so I would net those off prior to any sort of bail-in arrangement if it was the banker talking. However, if you were the regulator, you might actually say, well, actually, this is about the sustaining the overall bank, and therefore converting deposits to equity is something which may actually take preeminence over right of offset. Now, there's no case law on this. There's no words in any of the documents that I've seen to explain how this might run. My point is it's very unclear. It's another reason why we need clarity on what the bail-in provisions are in Australia, whether deposits are in or whether they're out. It's unclear. Those of you who have seen my earlier posts on bail-in will know it's all about any other instrument. And we also know, of course, that there are clauses in deposit accounts that allows regulators to effectively change the rules like that without any notice. So it's a big deal, and it's very unclear, Matt, I'm afraid. I guess my own view would be if we started looking as though things were getting really dicey, I think my own view would be I would probably use the money in an offset account and pay down my mortgage on the principle that a smaller mortgage is probably a good outcome, but others may have a different view. What constitutes disposable income? That's a very interesting question. Sorry, just looking at. I've missed who asked me the question. Disposable income is basically income that is available after tax. So you have effectively money coming in. You've got to pay the tax man whatever it is. It's what's left as available to cover everything that's required from paying the mortgage through to paying all the other bills. That's what disposable income is. It's a better measure than gross income because, of course, the impact of tax has a significantly different impact for different types of people. In fact, more affluent people have much better tax planning techniques and can actually manipulate their disposable income to make it a lot smaller. And that's getting into the tax engineering debate. But that's disposable income. So Paul DeWitt, what do I think about Peter Schiff? Yes, I do watch some of what Peter says. I think in some cases I sort of agree, in some cases I don't agree. I can't really debate that at the moment, but perhaps if I can ever get Peter to come and talk on the channel, that would be a good thing to do, and we can then chat some of those things out, I think. Okay, Brenton says, I'm wanting to get hold of the monthly data of price falls gains on a suburb by suburb level. Is the only way to get this to pay CoreLogic? Okay, so there is some information which you can get from realestate.com.au at a postcode level, and they actually give you trend data. You get it month on month and month for units and houses for every postcode in the country. That is available, but it's only available by putting an individual postcode in and pulling the information out. The CoreLogic data that's publicly available is normally much higher level, and you have to actually subscribe or grab the individual data within CoreLogic. There is no place that I'm aware of that lists on a location basis across multiple locations all the different movements on a monthly basis. Now, I have some of that data in my models, but there's a whole lot of processes I have to run through to get those. I actually take as part of my inputs, sort of ingestion of data, and I use that as part of the modelling that I use. But I use other sources too. So it's a good question, but there isn't a simple answer to that. And I think in New Zealand there is meant to be some information that's available, but I suspect that it's rather similar. And with all of this information, the question is, how accurate is it? how long does it take to actually come through from the data. So sorry, I can't give you a better answer than that. Okay, Katrina says, does bail-in mean we essentially become bank shareholders? Yeah, well, so the core thinking of bail-in is what you're trying to do is you're trying to stop a bank from falling over completely, right? And there's a reason why people might want to do that, because if you remember the deposit insurance, which we have in Australia but not in doesn't exist in New Zealand. In Australia, there's this 250k deposit insurance, which is available if a bank folds completely, right? But bail-in is prior to a bank failing. They're not the same thing. And it's interesting how quite often when MPs answer the question of bail-in, they end up talking about bank deposits, which is completely different. So far as bail-in is concerned, it's a bank that's in distress. They then grab some other classes of assets and essentially convert them into equity to be able to bolster the balance sheet of the bank. That's what it's about. And the idea is that, equity varies in terms of its value. It might go up, might go down, which means that you might actually find that your deposit is worth less. And in fact, there are in Crete, where there was a bail-in, people ended up losing quite a lot of their deposits as part of that process. So that's what the rationale is. And underpinning it is the G20. So they basically, a few years ago, cooked this up as an alternative to the government bailout of a bank, which the other way of doing it is effectively you get public money thrown at a bank to keep it afloat, which is what happened in Europe and in the US. The trouble about that is it's a huge impost on the economy, and you could argue that many economies around the world who bailed out banks are still trying to deal with the ramifications. We've done several posts on this if you want to look at them, highlighting the quantum involved. So basically the G20 came up with an alternative, and in fact it was a couple of bankers who came up with this idea of deposit bail-in. But that's where it came from, I think from Credit Suisse, as I recall. And it's sort of now taken flight. The Financial Stability Board basically put the paper out, the G20 endorsed it, and that's basically, it's law in a number of countries, it's law in New Zealand. So there you've got your open banking resolution. It's law in Canada, it's in Europe, in the UK, and sort of in Australia, although in Australia, as you may know from our earlier conversations and posts, the problem is that it's very fuzzy, so it's not clear precisely what's in and what's out. We know that some types of securities are definitely bailable, and the question is deposits. But the short answer is it would be converted into capital, and that bolsters the bank effectively, so you become a shareholder of the bank rather than a depositor. And underpinning it is the concept that a deposit is effectively an unsecured loan that you make to the bank. Now, that may sound really weird, because a lot of people will just say, well, aren't I giving my money to the bank for safekeeping? And the answer is no, not really. What you're doing is you're making an unsecured loan to the bank. Now, think about that. Unsecured means there is no security behind it. And the rates of return that we are getting on deposits around the world, but particularly in Australia, are so low, it doesn't actually represent the risk that is really there. And of course, in New Zealand, where the bail-in arrangements are even more crystal clear, now the Reserve Bank in New Zealand provides a dashboard, a scorecard, so that people can actually make an equation of the different risks of different lenders and work out where to put their deposits, because not all banks are equal. In Australia, we don't have that information. I did a post the other day about sheep and goats, and made the point that it's very hard to get really good information about that in Australia. So therefore, yeah, you become a shareholder of the bank by default, and the idea is that means that the bank doesn't fall over, which means that you then don't have the deposit insurance scheme or anything else. That's the way it works. Okay, Ian's asked, how do your scenarios impact super funds? Yeah, good question. So super funds. Now, the question with super funds is, where are they invested? So a lot of them will have a portfolio of investments which would include the equity markets, some bonds, some cash, maybe some offshore, depending on your risk profile. So the super is effectively in different asset classes. And the question is, what happens to that asset class that's in a crisis? Well, the answer is we know that stock prices will drop. We know that the bonds may go up, they may go down, depending on the circumstances. We know that other asset classes are also at risk. So there is no guarantee with regard to the overall value of superannuation. Now, that's sitting in deposit accounts in some situations might be something which is secured by the deposit guarantee in a failed bank situation. Or, I suppose you could also argue in a bail-in situation, those deposit accounts could actually be grabbed. So superannuation, I think, is a risk, and I'm not sure that people understand the potential risks in the super system that we have. It's more than $2 trillion, but it's invested in other things, asset classes, and those asset classes are market exposed. Okay, this is from Darryl. There's rumblings. Whoops. Missed. Sorry. I moved my finger and I've lost it. Let me try and get it back. Sorry. Okay. Sorry, I'm just trying to find the one about rumblings. I'm not sure that I can. Oh, there we are. This is from Darryl. There is rumblings that the central banking system is currently looking like crumbling with an audit likely to be conducted on the Federal Reserve. Ramifications for property. Okay, great question. Yeah. So here's the thing: the central banking system is, of course, in the US privately owned. So the Fed and the other central banks, the Fed structures in the US are privately owned. So they're not actually government controlled the same way as, for example, in Australia. So the Reserve Bank in Australia is actually owned by Australia, basically. And in fact, the Reserve Bank, when it makes a profit, as it does some years, it passes it back to the government. So the Reserve Bank here is not privately owned. In other places it is, and that raises some very interesting questions, particularly in the US, with what the Fed is for and how it works. And there are other examples around the world where, in fact, perhaps some of the dynamics of the way central banks work are a little bit suspect too. And so there is some talk about having extra forensic analysis of some of these players. Now, there's an implication of that, of course, because if in fact we discover that the central banks and the way that they are operating and the assets and liabilities that they hold are not as advertised, that could create considerable uncertainty. And I think it's probably that market risk which is the most considerable risk relating to the question of property. So any uncertainty, particularly levels of trust or no trust between entities, has a significant impact on liquidity. Liquidity is something which effectively flows around the international banking system and allows the cogs to turn the way that they've turned for a generation or two. But if that liquidity dries up because people no longer trust, then at that point, a lot of things go terribly, terribly wrong. And, that's what happened in the GFC. We had a liquidity crisis, effectively, and that created then the fall in home prices. So I think you could assume that home prices would take a significant dive. Okay, let's go down my list. This is from Tobe's family. Any comment on fintech lending, its effect on the Australian residential property market? Yeah, interesting question. Yeah, the short answer is I'm sort of involved with a few fintechs and advise a few fintechs, and I've been looking at this sector of the market for quite some time. And there are some amazing models there which are looking quite interesting. Now, of course, the fintechs are still quite small. They now are able to get preliminary banking licenses from APRA if they need that. And ASIC has also given a bit of an on-ramp to the fintech sector. So that it has some potential. The question is, how could it play out? So it could play out around a few things. Firstly, some of the fintech models provide different funding models. So effectively matching, for example, individual buyers and sellers and creating a transaction. So rather than going through an intermediary, you actually create a set of direct relationships. Other fintechs are actually looking to financialize further property and sell bits of properties. I personally have a bit of a problem with that because I think we're just creating more of a financialized world rather than less one. But the third is also the advice and, if you like, navigation around solutions. And I think that some fintechs could do some quite good work there. So my own view is the fintech sector is one to watch. Not very big here yet. It's developing quite quickly. And there are some interesting business models. Would it ultimately disrupt the main game? Not in the short term, but in the medium term, it has the potential. Okay, somebody's here asked, do you foresee RBA decreasing interest rates? Okay, yes, my own view is that the next move in interest rates from the RBA is more likely to be down than up, the RBA, down rather than up. And that's because there is very little wriggle room. We've basically got very little ammunition in the system now with interest rates already so low. And we know that growth is weaker than we expect. We know that income is not growing very fast. We know that home prices are sliding. We know that the overall momentum in the economy is not what we want it to be. And there are not many levers that the Reserve Bank has. They do have the interest rate lever, and they can take the interest rate a little lower. Of course, the point there is the cash rate doesn't have much to do with the mortgage rates anymore because of the way that mortgages are funded from international markets. Those fund costs are going up, not down. And the second point to make is that there is a lower bounds, right? Because once you start taking rates more and more negative, you go to zero and then minus, you then move into zero or negative interest rate zones. And there's some work that's been done to suggest that whilst you can go into negative a little, there's a point beyond which you can't go because you get no benefit. And the final point is, even if you take rates lower, there's absolutely no guarantee that those are actually passed through and it will have much different. So my own view is that there will be rate cuts, which will not have a major impact. There will be quantitative easing, so basically putting more money in the system to try and actually support the system, and that will potentially create greater inflation and asset bubbles again, but that probably will not be very successful. And essentially, that's one of the reasons why in my sort of more extreme scenarios, we actually think that things go pretty pear-shaped, and it's because effectively there is little firepower. And I know the Reserve Bank the other day did say, well, we've got plenty of firepower. We can do QE and we can take rates lower. And the answer is, well, they can to an extent. But my own view is that there isn't a huge amount of leverage that they can create off the back of it. So I think we're in a rather uncomfortable situation. That's one of the reasons why the Fed is so committed to trying to raise rates to get them back to more normal levels, to give them a bit more firepower for the next crisis. Unfortunately, what we've done is we've shot our locker effectively, and we've got not much left in the locker. So that's the problem. Okay. Prices drop to low depression. Yes, Bruce, I think that's right. So I'm of the view that we're going to see a continued drift down in home prices. We're going to see the economy continuing to weaken. We're going to see cracks appearing. We're going to see defaults beginning to rise. You know, I can give you lots of reasons why things are going to get worse. I really struggle to find a narrative that actually can be optimistic because, you know, okay, migration is there, but it's not sufficient to mop up all of the supply of property that we've got. Could we see incomes really start to take off? Well, maybe, but, you know, we're not seeing much evidence of that at the moment. And everywhere I look, I can see reasons why things are going to go less good. It's very tough for me to see things go more good, which is why I tend to be on the negative side of things at the moment. It's not my natural disposition, by the way. It's just the way that the data is representing itself. And it becomes a bit of a question as to whether we're going to have a slow Japan-type grind over, you know, a generation, or whether we're going to have a more severe fall and then perhaps some sort of recovery. Now, there are arguments for saying if we're going to have a fall, we might do better to have a deeper fall earlier and then sort of, you know, reset and go forward, rather than try and keep the balloon in the air and just grind forward like Japan has done. Because I think that fundamentally the Japanese economy is still dealing with precisely the same issues that they were a decade or two ago. Okay, what else is going on? So Genevieve suggests a bit of everything is good. A bit here, a bit there. Yeah, you're probably right. You know, the point there, of course, is that spreading the risks is normally good, right? So basically the portfolio view of the world is that you invest a bit here, you put a bit over there, you cover your risks. You don't put all your assets in the property or any other basket. What you try and do is to try and spread the risks. And generally, you have to say that that's probably reasonable advice. The problem is, in the current environment where so many asset classes are overblown and are likely to correct, the question is, do you just spread the risk but also not necessarily mitigate the risk? And that's the dilemma, I fear. Okay. I noticed a lot of conversations about Bitcoin. Well, no one's asked me about Bitcoin specifically, so I'm not going to talk about that. Now, Marty Grover, I think, said stagflation. Yep, could well be. That could certainly be one of the things that we see. In a way, we've already got some of the early signs of that with such low wage growth, with asset prices falling. I mean, look at property prices. They're going to continue to slide. The confidence in the economy, driven by the wealth effect, is positive on the way up. So effectively, people spend more because they've got, property prices rising. But the reverse is also true. And effectively, as confidence ebbs away, it tends to actually reduce consumption. Consumption, of course, has been a critical component of the Australian economy for a long time. Interestingly, in the US, it's 2/3 of the economy in the US is consumption-led. It's not quite that high here, but it's not far behind. So the US is completely sort of wired into consumption, but stagflation is certainly a potential outcome, I think. Okay, world oil reserves, this is from Gold Lad, estimated to run out in 55 years' time. Will it be another Mad Max scenario? Maybe you could have this as your final column. Well, yeah. Now, there's a big discussion about energy and the environment and all those things, and we've touched on this a few times in a DFA. My own perspective is simply this: that we have to find a way to shift the momentum in the economy to alternatives that actually are more sustainable and available into the future. And the oil conundrum at the moment is, of course, prices are quite low there in the US. The WTI is about $50, which is quite low. And that's partly because of production in the US and partly because OPEC can't actually control the way that it used to, and Russia's still providing oil. But, the whole oil question is, I think, a strategic one, insofar that the right answer is to try and wean ourselves off it over time, not only because of the global warming, but also because of the systemic risk that you touch on. Okay. Now, the New Voice 8, what is the chance of a so-called soft landing? Noting it looks like the stock markets may crash, as well as potentially New Zealand, UK, US, Canadian and Chinese housing markets. Yeah. A soft landing is what people talk about when they don't know what else to say. They basically are hopeful that, we'll drift lower, but, all the signs are there that the rate of decline is slowing, and there is no evidence in any of the data that I see of any sign of a soft landing. In fact, the rate of house price falls in Sydney and Melbourne are accelerating. The auction clearance rates are continuing to fall. And you could go on. So I think that it's a little bit of a fool's paradise at the moment. I've studied a lot of home price crashes over the years, and I've looked at other financial crises as well. And I have not seen any successful examples of managing a soft landing. We always get a significant decline at some point. And the question really is, what shape of decline? Is it one of those over a number of years, or is it more precipitous? And Harry Dent, for example, says you will know when there is actually a real correction, because you're going to see a 15, 20, 25, 30, 35, 40% fall. Then you'll know. Until you see that, you won't know whether it's really is a real full-down crisis, or whether it's just a sort of up and down. I sort of agree with that, but I really am struggling, given the pressures we've got in New Zealand, in Australia, Canada, the UK. So UK just came out with a very bad piece of news on home prices there as well. China, retail spending down. There are so many negative indicators, and if you put them all together, you start to think, 1929, I fear. Hope I'm wrong, but, you know, what's interesting is that some of the strategies that were being talked about pre-1929 are being talked about again. So I'm a bit worried that we might see history rhyming, if not repeating. Okay. What do you think of the looming large amount of Brisbane apartment completions that will come on Brisbane house prices? Sorry, I haven't read that very well. What do you think the impact of the looming large amount of Brisbane apartment completions will have on Brisbane house prices? Good question. That's from Maka2225. Look, there is a lot of development in and around Brisbane CBD and just beyond. A lot of those apartments are being constructed, and many of them are now being offered at prices which are 15 to 20% below where they were offered a year ago. In some cases, people have bought off the plans at those higher rates, and then when they try to get a bank mortgage, it's lower because the valuations have dropped. I think the supply is remarkably strong over the next year or so, although I have noted also that some builders have slowed the construction rate to try and actually maintain the pipeline a little better. It's going to have a very significant impact on unit prices, particularly in and around the CBD. So I'm expecting those to drive quite a lot down from where they are. House prices, in other words, things that aren't in high rise but actually are standalone, I think are more sustainable insofar that there is a more limited supply. There's still quite some demand. But even there, my expectation is that home prices will also slide. And we're also seeing evidence of that in the satellite areas around Brisbane. I'm particularly worried about places like Toowoomba, for example, and places like that where we're seeing mortgage stress very high. And I'm also worried about what I'm seeing in the Sunshine Coast and on the Gold Coast, where there's been massive construction, massive overbuilding, and very, very high prices. And some of those are coming back too. So I think that the southeast of Queensland is going to go in for quite a bumpy ride, and I do think that the units in and around the main part of the Brisbane CBD are up for a bit of a fall simply because of that supply. And it's interesting to note that we've got a very significant number coming on stream over the next little while. Okay, so somebody's suggesting that John Adams should be PM. Luke says, when are you going to start a political party? It's not really my bag, frankly. I think there are others probably better placed to do that. I think that my niche here is to use data to try and actually inform and educate and help people to understand rather than actually that. But that's just my own view, I guess. Okay. DV says, if detailed property information was widely available, then the wrong people would get it and report on it. You're quite right. That's a very good... The amount of information that is restricted is quite remarkable. And if you look carefully, there are certain ways that the information is presented through certain channels into the mainstream media and those things. I mean, auction clearance rates is a classic example. Remember that you can't really just think about auction clearance rates, but you've got to think about the volumes as well. Volumes are way down. The number of transactions are way down. And yet that's hardly ever reported. It's always the auction clearance rate. And then if you look carefully at the way that the auction clearance rates are calculated vis-a-vis the number listed, the number actually that are sold, and those withdrawn, then you can see there are holes in the numbers too. So there are various aspects of the data which tells you that you're not getting the full story. And what I try to do in some of my posts is to try and, if you like, give you the alternative perspective. If you want to look further at auction clearance stats, I've done a couple of posts earlier in the year specifically on that and why we can't trust them. Okay, John Fowler said, if the four major banks' total capital is less than 10%, what happens when the housing market drops to 15 to 20%? Okay, good question, John. Now, here's the thing, right? The bank has lent a loan. The loan is on a property, and there will be an equity amount between the amount of the loan and the value of the property, the loan to value ratio. Now, typically what happens is, let's say the bank lends at 80% of the property price, so 20% is actually then the equity that the individual or household puts in. That's what goes first. So in a fall, that's what goes first. And people need to understand that in a falling market, the bank doesn't lose first, you lose first, because you're losing equity. And that's really painful. But there is a point at which you then move into negative equity, and that means that the value of the loan is more than the value of the property. When that drops down, the question is, what does the bank do? Because at the moment, the banks do not reassess the value of the property unless there's a subsequent transaction. So they basically take the data that was there when the property was actually originally underwritten. And what that means is that we've got now a situation where the banks potentially are sitting on property values that are actually above what they really are. That's one of the reasons why a lot of the bank economists don't want to talk about negative movements in price, because they might be forced then to actually revalue those properties. So that's the first point. The second point is that negative equity is a theoretical problem. It's a paper problem until somebody goes to sell, and then when they sell, they're stuck with effectively a loan that they can't repay. So there is not a direct correlation between a slide in property values and the bank's capital, right? And the final point is that the way that the bank capital works, it's not even 100% of the value, because there's a thing called a risk-weighted asset, right? And so some property will require a risk-weighted asset not of 100%, but a much lower proportion. So in the case when they actually go wrong, the amount that the bank actually needs to put aside will be a lot lower than the full value that's dropped. So effectively, home price falls of 20% doesn't have an impact to the banks at 20%. It's much, much smaller. Okay. And in fact, the thing that is the most critical trigger for the banks is actually people who are defaulting. If defaults rise, they then have to put provisions aside for those, and that then requires 100% capital weight for those provisions, and that has a significantly bigger impact on the bank. So in fact, it's income growth or lack of it, unemployment rising, defaults, those are the things that have a much greater direct impact. Home prices are a more theoretical problem until people need to move. And of course, in the UK, where there was a very significant shift into negative equity, a decade later, many households are still stuck in the same property with a value that's still below where it was when they got their original mortgage and are still in negative equity. And that's the problem. It's a long-term issue, but it doesn't necessarily impact the bank's capital directly, immediately. Joseph Wilkes says, data in Australia is awful. In the UK, everything is recorded in public via land registry and net house prices and Rightmove. The data is easy to collect and share. Agreed, Joe. Yeah, absolutely. I came to Australia some years ago and I was horrified at the lack of really good information that was here, and it's no better now, I'm afraid. Damien says, would any of your data be a useful resource for those looking to purchase in the future, watching the increasing mortgage stress in a particular postcode? Yeah, possibly. There are actually a couple of sites that show distressed property prices and particular assets. If you do a Google search, you'll see them. What I'm looking for here is mortgage stress is an 18-month to 2-year indicator of future problems ahead, because when people get into mortgage stress, they don't default immediately. It takes 18 months to 2 years, but it's a financial pressure that's building and building and building until the dam bursts and they have to do something. So it's a forward-looking indicator of the level of defaults and home prices 18 months to 2 years out. So it does give you a forward view. And in fact, if you look on the website, you can see that there are the top 20 postcodes that I list each month, which are the ones where the highest stress is there. Those are ones to look at if you're thinking of value later, possibly. And I also, of course, do a regular video blog where I go through the top 10 postcodes, again, highlighting those with the biggest potential mortgage stress issues. Okay, what else have we got? Trevor says, is bail-in possible for member-owned banks and credit unions? Well, the answer is we don't quite know. All ADIs, all banks, are potentially looked after by APRA. APRA was the guys who basically created the structure around the bail-in under the APRA Act, which was the thing that was passed back in February and had this any other instrument thing. So my own theory is that mutuals and credit unions have potential risks with regard to bail-in. But as I did a post the other day, I made the point that they have much higher capital and they are less exposed to derivatives and they're less exposed from a risk perspective in other ways too. So my own view is that some of those smaller players are significantly less risky compared with the larger ones. But of course, you can also argue the other way, which is to say that if one of the big four got into difficulty, the chances are that the government will probably have to bail them out in some way or other, whatever that will be, we don't know, because they're too big to fail, whereas in fact small entities could be allowed to trip over. So it's a little bit of a, damned if you do, damned if you don't. But my own perspective is that some of those smaller players are considerably less risky and therefore less likely to be bailed in because they wouldn't have the same issues. Okay, what else have we got? Are the mistakes, this is from Tony Turner, are the mistakes of the central banks genuine or is there more to it? Okay, so Tony, okay, so I talk to people sometimes who say there is a shadowy entity sitting behind the central banks and behind global governments, pulling the strings, and effectively there's a master plan that's going to get everybody into massive amounts of debt and then basically make a killing. I mean, that's, no, I don't believe it, right? I believe more in the cock-up theory of history rather than actually the conspiracy theory. There is a set of common values, which is basically, the neoliberal view of the way that economies work and the fact that we should privatize it all and we should actually let the banks have their day and all that sort of stuff. That is widely held amongst central bankers and amongst politicians in a whole bunch of different countries, and therefore there's a bunch of similarities in the way that they behave. And even the central coordinating functions like the Bank for International Settlements and the Financial Stability Board have those same sets of values. Although interestingly, the Bank of International Settlements is now starting to throw rocks at some of the behaviours. Give you one little example. They made the point the other day that there's a lot of window dressing being done at the end of the quarter when banks are required to report their ratios. So they're now saying they want to change it so it's an average across a quarter rather than just a day. So one example. So I don't think that there's actually, something shadowy behind that's calling all the shots. I think there's greed. I think there's a common set of values. There's a view that the wealthy component seem to be able to actually get ever more wealthier on the back of everybody else, but that's more to do with the way that capitalism has been allowed to run. I don't think that there is something else behind that. Could be wrong, and others will claim that I'm being naive, but as I say, I believe in the cock-up theory of history. Okay, what else have we got? Okay. Why don't this is from Mac Dad, why don't the badly behaved banks get charged? I assume you mean from a legal perspective. Yeah, it's a very interesting question. If you go back to the 2008 crash in the US, almost no bankers were ever sent to court, prosecuted for their massively bad behavior. And in fact, the banking system and the government was so close in the US that there was a lot of open doors between the two, right? So a lot of the central bankers were actually ex-bankers. And so not surprisingly, the solutions they come up with are actually designed to protect the banking system to behave the way it has and continues to behave. Now, it will be interesting to see whether the review, which will report in February, of course, the Royal Commission, whether they will actually come as far as recommending criminal proceedings Because you could argue that the evidence over the last few months was that there were banks and bankers who were deliberately doing the wrong thing, and transparently so. I don't know. I think it will be actually good for the banking system if in fact some of those people were actually hauled over the coals, and actually people realised that there is a legal framework for a reason, like responsible lending. Responsible lending is there for a reason. It's not just there to tick the boxes, and yet most people in the banking system who sort of knew what responsible lending was about, skated around it. So it's a behavioural question, and I actually think we need to think about structural alternatives to the banking system, because I don't think the banks are capable of converting their own behaviour from the inside. I think a lot of the senior people inside the banking system are captured by a particular way of thinking. So we need to find alternative models which effectively swings banking back into something which supports the broader economy and supports the broader community, and isn't just about maximising returns to shareholders. And that takes you to a really interesting question, right? Because, of course, the model is, in the privatised banking world, to maximise returns to shareholders at all costs. Never mind if you actually break rules in the process, frankly. That needs to change. And there has to be some checks and balances about behaviour and about doing the right thing for customers. And by the way, all the research that I've done suggests that those banks who really are customer focused and really do focus on delivering the right outcomes to customers in the long term can actually still return good returns to shareholders as well. But that's another story. Okay, what else have we got? Do you pay your survey participants? That's from Still Happy. No, I don't. The way it works is that the surveys are executed on my behalf as part of an omnibus research program by one of the big research companies in Australia. So they ask a whole bunch of questions, including my questions and other people's questions. But I don't pay any individuals for their survey responses. I just get a statistically optimized, robust set of data back each month, which I then run through my model. So that's the way it works. Okay. This is Goldlad. Do you have a top 20 to 30 worst suburbs for mortgage stress? Was there any Latrobe Valley towns? Yes, Goldlad. It depends whether you mean by total number or whether you mean proportion of households in stress. If you want to send me a separate email with regards to the area that you're interested in, I can tell you precisely the data on that, because I have it down to a postcode level. It may well be that the population footprint is not big enough to be in the top 20 or 30 nationally, but I can certainly answer that. Okay, that's what else have we got? David Silverweb. The RBA sets the rate at 1.5%, yet the Aussie banks have to borrow at a higher rate from overseas. Why? Good question, David. Short answer is that the cash rate has very little to do with the real funding rates for the banks these days. They are paying a lot more, particularly for the fact that LIBOR's going up. The BBSW, as I showed you earlier on, is the bank bill swap rate is going up. And they're having to pay more because effectively foreign investors are putting a risk weight premium on Australian banks. So they're having to pay more. That's very disconnected from the cash rate. And because of the fact that 30 to 40% of bank loans are effectively linked to overseas investments rather than deposits, there is not a direct correlation between the local cash rate. So you could argue that the Reserve Bank is pulling this interest rate lever and it's not really connected to much anymore. And of course we saw several out-of-cycle rate rises previously, less rate cuts. But the other side of the equation, just to complete the story, is that deposit rates are being absolutely hammered. So if you've got a term deposit, check your term deposit rate. You'll discover that it's significantly down on where it was, particularly call accounts actually, but even term deposit accounts, because effectively what the banks are doing is they're discovering that they can squeeze the deposit rates to bolster their margins more easily than they can change the mortgage rate, because every time they change the mortgage rate they get hit over the head with a 4x2, because of course they're really sensitive to mortgage rates, which is wacky because a third of the population who have no mortgage are very reliant on deposits, and yet it's a silent majority. And I never understood why it is that the silent majority just accept these very, very low deposit rates. Seemed weird to me. Okay, what else have we got? Okay, this is from Anthony Brown. If we get a scenario 4 or 5, could our household debt to income percentage go under 100%? Okay, so the question is, what happens if we get a crash, right? So we know home prices will fall. The question is, what happens to the debt, right? Because there's a couple of scenarios. One is nothing changes and the debt still stays the same, which would mean effectively that the ratio of debt to everything else will go even higher. Or we may have to consider some sort of debt reset or even debt jubilee, to quote Steve Keen. And debt jubilee is basically forgiving of debt, because effectively the theory that's out there is that in this environment the debt has got so big that it will never be paid off, and it will be a continuous burden to the society and to the economy, and therefore it needs to be handled. So it depends, I think, on how this all plays out. And there are people seriously looking at, after a crash, how do you handle the debt? Do you actually reset it to zero or reset it to a smaller amount? There's a thing called the Chicago plan, which I've done some posts on a few months ago, which is effectively trying to think about what you could do about that. Steve Keen's debt jubilee is another idea. So there are various alternatives, and how that plays out will give you a different answer, I think. Conrad says, is that your kitchen behind you? Well, actually, I'm downstairs in the pool room. We have a big room here, which is the studio as well. But behind me, there is actually some kitchen units, because there is a small kitchen in the corner. Bail-in question. Will the banks repay the bail-in funds stolen from depositors once they're on their feet again? Well, very interesting question. That's from Tis Not. Tis Not My Name. Very interesting. Very good. The answer is nobody knows. So in the case of Crete, they got a proportion back. In New Zealand, the official story from the Reserve Bank in New Zealand is they'll take the deposits, they'll use the deposits to refix the bank, and then they'll give you back some or all. So nobody quite knows. Okay. So this is from IS Kundi. So we might be facing our own decade of financial repression. Well, it's certainly very different, right? It could well be that we're going to find it much tougher to borrow, much tougher to get credit, much tougher to be able to do a whole bunch of things. So, yeah, it's looking to me as though we're going to have a long, slow grind. I mean, Japan, I think, is an interesting model. The Japan economy is not doing too badly, but if you look at asset growth and if you look at other things too, it's actually, not performing hugely well. We do have, of course, resources here, and providing that the resources are still being bought by China and other places, we've still got a little bit of a get-out-of-jail card. And, of course, that's what the MyEFO showed, that effectively the budget looks a lot better because of the fact that people have been buying more of our commodities than perhaps we expected at a better price. But that's a very risky one-trick pony. And the question is, what else have we got in the locker? And I keep saying to people, we need an alternative strategy for our economy to try and deal with some of these things. And one of the reasons why DFA is here is to try and actually get some of these discussions going before everything sort of turns to custard, right? Because there is still a chance that we can actually pull some levers and do some things differently and get a different outcome. The trouble is, the more we leave it, the more our politicians just sort of carry on regardless, the less chance there is of fixing it. Okay. What would the banks do if depositors started extracting deposits in cash? Would they improve the interest rate to attract cash back? It's an interesting question. So we certainly have seen scenarios where, I guess Northern Rock was a good example in the UK, where effectively if you lost confidence in a particular bank and actually queued to get money out. Now, of course, it's quite hard to get money out. So if you try and go to your bank and get a larger amount of money out, they'll say things like, we need notice, not least because there's not a whole lot of cash in the bank necessarily these days. If you go to an ATM, there's a limit as to what you can draw out in a day. It's actually quite difficult to get large amounts of cash out. So some would say that's just operational reasons. Some others would say, well, maybe there's a bit more to it than that. And of course, it's interesting that in the UK, they're talking about reducing the supply of large banknotes to, again, make it a little bit more difficult to sort of move large amounts of money around. And they're using the example of the black economy as a reason for doing it. So effectively trying to, work within the system rather than around it. The short answer is it's really quite difficult to know, but I'm not sure that banks would respond that well if, in fact, people said, well, give me a higher rate or I take my money out. But it would be interesting to see. At the moment, if you look carefully, there are a small number of players who offer slightly better rates, but, they're all marching to the same beat. And one of the things I've said to some of the clients that I've worked with over the years is, you should be different. What you should be doing here is trying to offer a different proposition, a better rate. Or better still, if you see that somebody's not getting the rate that they could get, tell them, offer them the better rate, because that's a different cultural norm than what we've got at the moment. At the moment, the banks try and get away with blue murder and try and, price their deposits as low as possible. There is an alternative model. Okay, what else have we got? Whoops. What would you personally do to protect your assets? Where is your money invested? I assume yeah, this is from Marcus. Yeah, well, okay. So yes, I don't have a mortgage. I made it my imperative to pay the mortgage off as soon as I absolutely could, because I hated paying interest on it and I wanted it to be effectively mortgage free. So yeah, and I've ridden the value up a little. I'll ride the value down a little. At least it's mine, and nobody can take it off me. What I've then done personally is I've actually gone to liquid. So I've liquidated a number of other assets, and I've tended to slice them and dice them and put them into different organisations below the insured amount on deposit. And I also have got a little bit in the US as well, thinking that the US is an interesting angle from a exchange rate perspective, but not very much. And a little bit in the UK, same reason. That's more a speculation. So that's what I've done. But I don't hold gold. I don't hold silver. For the reasons I'd explained earlier on, for me, it's too unknown as to what the risk is, what the value is, and what the outcome might be. So that's just my own view. I'm not saying it's right, but that's just what I've done. Okay, Eric says these conspiracy theories that everything wrong is yes. I'm not going to sort of read the whole thing, but yeah, there are people who hold conspiracy theories about the banking system. As I say, I think it's more to do with the fact that there's a common set of behavioural norms rather than a conspiracy theory. That's just my own theory. Okay. Okay, it's an interesting one. Hope lives on. There is talk that the US may go back to a gold standard. Should we follow? Talk to John Adams. So look, the fact is, money at the moment is disconnected from real value. John did a great video on this a few months ago, right? In fact, the value of money can go up, but in real terms it's not. So effectively what's happening is that there's a real devaluation going on because there's nothing supporting it. So the argument is if you have something tangible like gold, you have the chance then of anchoring it, and therefore you get real value. That's the argument. There have been various attempts over the years in various countries to go back onto a gold standard, but then they've broken it and come off it again, and then just inflated the economy. The 3% CPI, it just grows and grows and grows and grows. And that's really the key question, right? So effectively, if you think the future is perpetual growth, then anchoring it to something tangible isn't necessarily that sensible. But my own view is if you want to find an alternative model for the way that a banking system can work, then there isn't definitely a place for anchoring it to something, whether that's gold or something else. Okay. 9:16. We're getting, to the end of the questions, I think. Peter Smith says, how can I come and work for you? Yeah. Well, we do this on a shoestring, right? So just to be clear, there isn't a lot of monkeys in the back room, right? It's basically John and myself and Joe and a couple of other people who do various things. But yeah. Okay. Question about, do I trust Trump more than the Labour or the Libs? No, I don't trust any of them, frankly. I have no confidence in the political class whatsoever, I'm afraid. They have betrayed core beliefs, they've betrayed the broader society that they're part of, and they're out for their own ends, I think, rather than the greater good of the society. That's the problem that I've got. So I come at it from the other way and think about it from the point of view of the community and what the community needs to be successful and to be able to do the things that it needs to do and wants to do. It seems to me that the political class is just in a different world altogether. Marcel says, keen to hear more about risk weights and capital requirements. So you're the one. Yeah, I did a post the other day on that. Go and look at it about sheep and goats. I will do a more detailed one on the risk weights. Somebody asked me the other day, show me how a bank balance sheet actually works and how the risk weights work. So that's on my list of things to do. So I'll come back to that. What else have we got? There's a question there about Benny Hill and Michael Pascoe in the same sentence, but I won't read that one out. This is from Genevieve. An independent builder friend of mine asked when the market would bottom out. I guess 2 years before jumping into more building projects. It's difficult to know. I have got more and more data coming out from my surveys, particularly the SME surveys, that builders are really struggling, particularly small builders, and they're finding that the flow of work that they had is drying up, and therefore it's much less easy than it was for them to be able to continue to run the business that they'd want. They're getting it harder, finding it harder to borrow from the banks as well. I don't know whether it'll be 2 years or whether it'll be longer. It depends on whether we have a deep sort of quick fall or whether we have a slow slide. There is very little evidence that I'm seeing of demand picking up for new property. We've still got a lot of property supply. It's even worse in New Zealand from what Joe has been showing in recent videos. There is a massive supply. Demand is quite weak at the moment. And we do have population growth, of course, and that's something. So, yeah, it could be 2 years, it could be a bit longer, I think. Peter Smith says, a politician's job is to get elected and then to get re-elected. I agree. Absolutely, that's the problem. It's a self-perpetuating engine rather than actually thinking about what's really appropriate and good. If you were sort of starting again, what you would want to do is to think about a more strategic view of how to, develop the country and the economy, and to lay out a plan that would take us somewhere into the future, rather than actually being limited by the short-term electoral cycle, which basically is you tighten them for the first couple of years, then you actually give more money out and try and get re-elected. Look at the MIEFA with the 9 billion of spending that will be coming through to try and bribe people to vote them back in again. It really does not serve us so well, in my view, but that's just my own perspective. Okay, well, we're close to the end. Anything else that... Have a look, see if I've missed anything. Okay, what I'm going to do is... So Bruce says, just buy US dollars or euros from the bank. Well, the US dollar, look at the US dollar movements. It is quite a strong economy at the moment. Whether it will be in a few months' time and whether the Fed will actually lift rates, there's a really interesting question in my mind as to whether they will. With all the stock market shenanigans in the recent days, could they put it off, or are they wired in to do it? I suspect they probably will do it in December and then hold their breath after that, but who knows? Okay, Ben says, will Australians start to pay more attention to labour pay conditions now that they will have to rely on wages instead of capital growth for advancement? Well, it's a very interesting question, Ben. Yeah, it really does come back to how the economy works and what's important. We've had the financialisation of our economy for a generation or two. In other words, capital growth, easy money, prices going up, home prices going up, saving for retirement in our homes and those sorts of things. I think that could well be now moving to a different phase where we're not going to see those same growth. The number of people who are still saying to me, house prices double every 7 years, as though that's sort of the gospel according to everybody. My own view is that's no longer true, and therefore we need alternatives. It does come back to what's a fair wage? How do we actually develop an economy that actually is providing, a better level of support for people? I think there's a bunch of very big picture questions which I can't answer on the stream tonight. Okay. Right, well, I am just going now to go back and tie up the ribbons on this, and I'll come back and have a last look at the... let's go there. Okay, so now just a few final points. Look, if you like what you see here, we do really appreciate support. We have a lot of people now supporting us, 180 via Patreon. We had 29 new people in the month. Tremendous. Thank you for that. It really does make a big difference to the way that we actually go about things. So Patreon is there. I know some people don't particularly like Patreon because of some of the way that they do things. There are alternatives that we can also talk about, but Patreon does exist. And here's the slide now. 29 new people supporting us. Thank you. There's also a new tier as well that allows you to put a little more in. So that's one option. There's another option as well, which is the PayPal Pay Me. So that's something which we've started quite recently. It's been quite popular. So thank you very much for those who chosen to go the PayPal route. That's sort of a one-off donation. This really does make a huge difference to us because there are costs involved in just creating all the shows and doing all the other stuff that we do. Every dollar that we receive goes back into the production of more things. So it's not, making profits and money. It's just helping to keep the thing ticking over. So please do consider that. We do really appreciate all the support we're getting. And I will also say that I've had a few people make other gestures too. And, I really appreciate every person who's signified in various ways their appreciation of what we've been doing. And I also appreciate all the emails and all the questions and all the copies of correspondence that we receive. It really helps to build out the story. Just a few top hits this month. So this is basically, the slide. The shows have done really well over this last month. There was Edwin Almeida's latest, came out yesterday, Sage Advice for the property market. Wonderful conversation with Edwin, worth watching. Joe did a great piece on baby boomers and the time bomb, very popular show, worth watching if you've not seen it. We had, of course, the John Adams assassination and the establishment strikes back. I'm sorry if I shocked a few people on that one, but actually it was a very popular one too. The mortgage stress that we publish each month, that proved very popular too. And then I did a show on the mortgage ripoff where I looked at the Productivity Commission report on the mortgage industry and the way that there's no loyalty. And then finally the bank risk, separating the sheep from the goats post that came out a couple of nights ago. That was the one where I tried to look at the risk profiles of different classes of banks because we can't really get more detailed information than that. So there's just some of the ones that are actually most popular. So I'm just going to go back to this one. That's pretty much what I'm going to, I think, cover tonight. I'll just go back one more time in case there's anything else that people have asked. What about crypto? Yes, good question. I'm looking at getting crypto as an alternative mechanism potentially. There's a little bit of thing I have to do to do that, but I am looking to do that. So hopefully we'll be able to do crypto a little bit down the track. As you say, it is censorship proof, which is, yeah. So I just want to say then, thank you to each of you and every one of you who've participated through the year on the DFA. We've had an amazing journey, right? Because essentially we started with few hundred at the beginning of the year. We've got nearly 12,000 now people who actually are part of the community, and I very much value the correspondence and the conversations and everything else. I'm going to close out tonight with my thoughts on 2019. So my expectation is that we will continue to see home prices fall. The likelihood is that we will see significantly faster falls in the first half of the year. And then I think we'll have to take a checkpoint around the middle of 2019 as to whether it's going to be effectively a continuation or whether we begin to recover. That will be partly driven by what happens internationally. I am concerned about the US. I think that we could well see that falling into difficulty later, although the inverted yield curve is marginal at the moment. I am very concerned about what's happening with regard to Brexit. I think that has some triggers as well. And I'm concerned about China. So there is international things. But locally, I'm afraid that I think the home price movements will continue. And what that means is that people need to be cautious about getting into the market at the moment. And as Edwin said the other day, you know, depending on exactly which type of purchaser you are, or probably owner you are, you perhaps will do different things. So that's my sort of thoughts. There will be some more material coming out over the next few days, which will continue through the holiday period. Maybe I won't promise to do it every day, but I will try and do it every day because I've still got this promise to get it through to the end of the year. So that's my plan. So again, thank you for all your participation, your comments and questions. If there's something that I missed, feel free to send me an email and I'll try and follow up specifically afterwards. Somebody asked me about Canberra. I haven't had a chance to look into Canberra, but I will do because I know people were interested in Canberra. I suspect prices will slide there. Supplies definitely continue to grow. Demand is tailoring off. And of course, we've got the election next year. So I suspect Canberra could be another market to look at in the coming months. And by the way, I also think Perth is going to continue to slide as well. I think the likelihood is that even Adelaide and even Tasmania will continue to slide. And I think New Zealand is probably in for a bit of a wobbly time too, but we'll let Joe tell that story in the next few posts because there are some early warning signs there as well. So I hope that you all have a restful seasonal break over the next few days and weeks. And we'll be back in 2019 with more stuff. There'll be another live stream, probably around the third week of January. And we'll continue our work. We think it's important. A lot of important messages to get out there. And not least, don't necessarily believe everything you read in the mainstream media with regard to finance and property because it's not the full story. So, with that, I think we are done. So thank you once again. And I'm now going to play out with the end screen music. So thanks for watching. Thanks for your participation. Have a good Christmas and New Year. And we'll see you again soon.